trading, a gap refers to a significant difference between the closing price of a financial instrument such as stock, currency, or commodity and the opening price of the same instrument on the next trading day. Gaps can occur in various markets, including stocks, forex, and commodities. As a result, the opening price of a new day may differ significantly from the closing price of the previous day. In this case, a noticeable price gap is formed on the chart. A sharp transition of the price to a new level without intermediate transactions, which is usually called the gap. If there is a sharp change in the balance of power between sellers and buyers, gaps can also occur within the day. Despite the fact that gaps occur quite often in the market, traders pay increased attention to them. This is explained, among other things, the presence of a long-standing trader sign which sounds like this: every gap must be closed. It is believed that if gap has formed on a stock chart of an asset, its market price will sooner or later return to the trade in the jumped range. That is to fill the gap that has formed. The sign quite often actually works, but you still shouldn't blindly believe in it, since the sign doesn't tell you exactly when the gap should close. There exist 4 types of gaps. A regular gap occurs when the price moves sideways with long trading volume. It tells us about the weak liquidity of the instrument. That is about the lack of interest in it on the part of traders. A gap when a level is broken occurs at the beginning of a strong movement price of the instrument and is accompanied by high trading volume. Its appearance tells us that a major player has finished gaining a position. An acceleration gap occurs in the middle of a price movement when increased interest of traders in the instrument. It points to a more likely continuation of the price move in the current direction. The exhaustion gap is deceptive in that it is similar to the previous type, but by its nature it resembles the dying convulsions of the current market movement and indicates an upcoming reversal in price dynamics. At this point, traders mistakenly believe that the movement will continue and they make active transactions in the same way direction. Price reacts to this with a sharp jump, which occurs on its last legs. Therefore, in the jargon of traders, such a model is also called a dead cat jump. This gap is accompanied by very high trading volume.